Hello and welcome. You are listening to the Investor Lab. My name's Goose.
My name's Gabby.
And today we are talking about, what are we talking about today, Gabby?
Property portfolio housekeeping and hacks for sustainable scalability.
Or, in fact, are we talking about how to know when to buy your next investment property?
They're the same thing. Come on.
So in today's episode, we really dig into tackling a problem that a lot of investors face. How to know when to go again. Is it more important to go fast, or is it more important to have the right cadence? You know, the tortoise versus the hare. What's going to allow you to win the race? How can you actually build the right habits and implement the right tools, tricks, and tips to make sure that you can stay on track to maximize your portfolio performance? And how do you get to your destination as fast as possible, as happy as possible, and in the best possible way? So I think this kind of ticks all those boxes. Did I miss anything, Gabby?
No, I think it's a really cool episode because we get a little bit more mechanical about the day-to-day, like how to actually think about, you know, your investment rules and what is reality in your life and things to look for to know that, okay, I'm ready to actually go again and this is the strategy that I need to take next. As well as, yeah, as you said, how to actually think about being a property investor in reality, like how to take it seriously, how to do some tracking of your expenses, how to know, you know, what the values are of your property on a frequent basis, all that kind of stuff. So super, super tactical one, this one.
Awesome. Well, and of course, you'll hear it at the end of the episode, but if you don't make it to there, I know that this is going to be really valuable for you, and it's probably going to be valuable for somebody else as well. And what really matters to us is that we try and help as many people as possible. And so we record this show because we want to help you. And if you can help us to help more people by giving this to somebody, sharing this with somebody, telling somebody else about this show, telling somebody else about this episode, then that would really mean the world to us. We don't ask for really anything in return with this podcast. We don't try and sell things or pitch you or do anything like that. But if you could really help us, that would mean the world to us. So make sure, of course, you like, rate, review, share, do all of that kind of stuff. But give this to someone that matters to you and help us to help them too. That would be awesome. Without any further ado, let's get stuck right into it.
Awesome.
We'll see you on the inside. Hey guys, welcome back to the Investor Lab. You're with Goose and Gabby. Gabby,
Hello.
How are you?
Really good. Really good.
Why?
Well, we just got some flash standing desks.
Did you get some flash standing desks?
Finally arrived.
If you're watching this, that's
yesterday.
why we're swaying.
We're
swaying like ships in the ocean. If you can't see us, this is just going to. If you're listening to this, if you're listening to this in audio, that's probably going to be a little weird.
Okay. Anyway. Yes, I'm well because I'm standing and moving my body a bit more, which is really beneficial in the last, 6 weeks of lockdown or however long it's been.
Yeah. Yeah, 100%.
Yes. How are you?
I'm fantastic. I'm great.
As always.
Yeah. Yeah, I would say like 95% of the time I'm awesome. Like, I don't mean like, look at me, I'm awesome. I mean, I feel great.
Yes.
Like I'm optimistic.
I'm awesome.
I'm optimistic and positive and all of that kind of stuff. So most of the time, yes, life is an abundance of joy and prosperity, and I love it. And of course, I enjoy hanging out with you, and I enjoy doing these podcasts. I also want to particularly point out that I'm loving the feedback that we've been getting from people, and there seems to be a little bit more dialogue coming through, people emailing us, giving us suggestions, feedback, stuff like that. We love that. This whole podcast, when we started it, 120 episodes ago, or whatever it was.
17 years ago.
The whole premise was that we wanted to be able to create content that was going to help people. That's really the premise of it. And yeah, it's exciting when we hear from people that it is helping them. And if that's you, then thanks. So yeah, what are we going to be talking about today?
Well, firstly, just before we get stuck in, I need to point out your hair.
Don't point out my hair. This is illegal. I broke the law.
What's happened to your head, Goose?
Oh, well, I managed to get a bootleg haircut, but we can't talk about that because I've broke the law. Anyway,
don't tell anyone.
No haircuts in lockdown, guys. No, don't do it.
Don't do it. Bad idea.
Bad idea.
Carry on.
I mean, I did it myself.
I'm very skilled with clippers.
Okay, so what are we talking about today?
We're going to talk about timing for, how to know when to actually buy your next investment property.
Yep.
And so you've been having a lot of conversations recently with people about really just like, how do I actually know if now is the right time to keep going again?
Yeah, totally. I think it's probably a couple of little parts to that. It's like, how do you know when to go again? How do you know how fast you should go? Should you try and go as fast as possible? Like, there's a whole bunch of stuff in there. And you're right, I've had a lot of conversations lately, just in the last few weeks, with people in different situations. So, for example, some people who are, say, a little later in life, maybe they're in their mid to late 50s and haven't really focused on their personal wealth journey, and they're going, oh my God, I'm running out of time. Let's just try and set fire to the world. I'm going to throw everything at it like a bazooka. Let's go. And then other people who are in their early 30s saying, well, I have time and I have a good life. So should I be trying to go faster? But what actually is the right cadence? Or, how should I be thinking about this? Am I wasting time and energy and effort and money? Like, should I be doing things differently? And I thought it was a really interesting conversation. I actually had a consultation with one of our clients on Monday where we went into a lot of this stuff. And I thought, wow, there's some real kind of stuff that we might be thinking about and talking about regularly, which maybe other people could benefit from. So that's kind of where we got to for this.
Yeah, awesome. Yeah, and I think it's obviously, like with most of our podcasts, it's a really important topic to think about, because particularly, like, we do this all the time, right? This is our full-time life. We do this all the time. We talk about this with the clients and with our team as well, all day, every day. So we're very involved in these kind of conversations. Yeah. And so if you're someone who's going through this kind of process and you're not, like, this isn't your full-time thing, it can be quite confusing if it's like taking up like 10% of what you're trying to think about, and you're trying to plan through, like, is this the right step? And you just don't really have, those people that you can reach out to and have a conversation with and can actually guide you through, like, how do I think about this timing thing? Like, do I do this? Do I just, like, I don't really know what I'm doing, but do I just, like, screw it, I'm going to try and do it and see how it goes? And there's, like, we're trying to kind of be here for those kind of people to be like,
totally.
There's some barriers here. Yeah.
It's mostly because people have, like, mental blocks. Like, have you ever had something that you know that you should do or need to do or could do, but because you don't really understand what's involved, you put up all these, it could be like a form that you've got to fill in and send to something, and you're just like, oh my God, I don't know what's involved, but oh my God, it just seems like it's probably going to be a whole heap of work, and I don't really want it. Maybe it's just me because I hate forms.
I was going to say, guys, if you ever want to, like, throw Goose into, like, just a downward spiral of, like, frustration, just give him a form.
Forms are my kryptonite. I don't do forms.
Out for a day.
I do not do forms. I don't do forms. Me and forms don't work. So if you're like me and you see a form and you're just like, oh my God, it's like a cat. If anyone's seen a cat, when cats meet cucumbers, if you YouTube cats and cucumbers, YouTube cats and cucumbers, that's me with forms. In any case.
It could also be like, so for me, like, the idea of, like, fitness has always been, like, a mental block for me, because it's like, I know it's something that, I want to take seriously. I'm at a point where I'm like, damn it, I need to like take this seriously and actually move forward. But again, like, I don't have the time and the endless resources to go and learn everything about it to actually know what my first step needs to be. And so you can pick something and, like, try it, but you actually don't really know until you try and learn it and think about the principles in the right way. And I think that applies here as well.
Yeah, 100%. So what we'll try and do in this episode is we'll try and give some valuable heuristics, mental shortcuts mental models and stuff that are going to help people to frame this up for themselves. So this isn't none of this is dictatorial. There is no one size fits all solution. However, my hope, and I'm sure Gabby's hope too, is that if we can help you to try and, like, get your thinking in the right way around this, you're going to be able to apply this in your own journey and work out how this is going to be beneficial to you. So the first point that I want to talk about, or that we want to talk about, is speed versus consistency.
What do we actually mean by that?
Okay, so in pretty simple terms, there's a couple of ways to think about this. So if you have got a finite time horizon, so let's just say you've got 10 years to build a property portfolio, and you're going to measure the success of your portfolio on, the final day of year 10, right? At the end of year 10.
Yep.
And if you're going to buy, let's say, 10 properties in 10 years, are you better off to buy 10 properties in the first year or one property every year for 10 years? Well, if you're looking at total performance, you're much better off to buy 10 properties on day one and just do nothing for the rest of the 10 years, okay? So, but what I see happening is people getting a little confused and sometimes a little on top of themselves in some ways when they're thinking about this. So, for example, one of the people I spoke to in the last kind of week or so he was in his late 50s and he hadn't prepared his wealth journey, and he's like sort of going, oh my God, look, we only have a little bit of time left before we're going to retire, and then we won't be able to invest. And so we need to go as fast as possible. But I could tell that there was a part of him that was reacting out of a place of like, oh my God, I'm running out of time. And they had plenty of equity in their family home and all of that kind of stuff. And so technically could and has good borrowing capacity, could just go and buy a bunch of properties, like, I don't know, 3, 4, 5 properties all in one go, bang. Now, the problem with that is that sometimes that's not necessarily going to be the best thing for you to do, because when we're talking about a quantum of, say, 5 or 10 years, the differentiation between, trying to do it all in the first 3 months or spreading that over a still relatively short period of time is not going to be a drastic negative impact. And I would suggest that there's a whole bunch of upsides. So when we're talking about speed, what we're talking about, just get back to the root of the question. When we're talking about speed, we're saying try and buy as many properties as fast as you can, right? And then consistency would be going, okay, what is the structured plan and the consistent cadence that I have that is going to get me to where I want to go? And the two very, very, very different ways of thinking about it. And I really want to talk about the pros and the cons. This is kind of like the tortoise versus the hare. And Gabby, just jump in and interrupt anytime you see something you want to hang on to, yep. Right? Because let's just think about this for a second. Let's say you're in a position where, I don't know, you've got a bunch of money and you want to go and you have the ability to go and buy, let's say 3 or 4 or 5 properties straight out of the gate, right? Now, you may go really hard, really fast and buy, let's just say 4 properties in 6 months, right? And you're going to use all of your available capital. That's gone. You're going to use all of your available borrowing capacity. That's all gone. And then you're going to stop, okay? Because you have to. You won't have any ability to continue to go on. So you might have gone really hard for 6 months. Now, a couple of things are going to happen. Number one, it's going to be a hell of a lot going on. It's going to take a lot of mental, you're going to be burning a lot of mental calories during that period of time because there's going to be so many moving parts. Not that there's anything wrong with that, because I do believe that pushing yourself and being resilient and handling pressure and doing all that kind of stuff, I really think that is a good thing, but it's something to be aware of, right? It's not something that you should accidentally go into. It's something you should be really cognizant about, the fact that you're going to be going and you're going to be putting yourself essentially through a boot camp, right, for like a certain period of time to achieve a goal really, really fast, right?
Yeah, which I think, yeah, I'd like to dig into that a little bit awesome. Later as well, because I think it's an under-considered. It
is definitely an under-considered thing, right? But here's the other side of the coin. You get to the end of, let's just say, this 6-month period, and you've gone in a flurry of activity. You've gone and bought a bunch of properties, and now you can't buy any more. Then you're not going to be able to do anything. You might not be able to do anything for, let's say, it could be 12 months, right? Let's say. But because you then park that to the side and then go and get on with the rest of your life, you haven't built the habits and the rituals around consistency and building wealth. And so the significant likelihood is that over time, you're going to be leaving more money on the table and eventually going slower, okay? So the way to think about that is if you went on a fad crash diet, for example, and you're like, great, you know what? I'm going to lose some weight. And you go on this, you don't eat for 6 months or whatever, and you lose 50% of your body weight, and you're like, oh my God, I'm skinny. And then for the next 12 months, you just eat whatever you want because you're like, look, I went on that diet over there. That's not actually really going to set you up for a healthy, consistent future, okay? And so what I often see happening is that people will go really hard, really fast and get themselves to a point where they can't continue to go on, and then end up putting a massive gap because life will get in the way, their priorities will change, and it could be 2 or 3 years before they realistically come back to their portfolio and go, oh my God, look, I actually have equity and the rent's gone up and I can actually borrow more and all of that kind of stuff. Where in actuality, they could have lost 6 months, 12 months, or 24 months of portfolio building time purely because they didn't build the right cadence into their portfolio.
And I think with that, like, I was just thinking about using that crash diet analogy again. There's no guarantee, there's virtually very little guarantee that you're going to be able to do that again. And I think some people think, like, in a crash diet, it's like you can lose a bunch of weight and then kind of like just like eat whatever you want, as you said, and not take care of yourself, not have those habits that you know are actually good for your sustainability of what you're trying to achieve. Part of that is because people just think like, oh, well, you know, when I'm ready, like when it gets out of hand again, I can just go and do that strategy again and like cut really hard. Yeah. And so I think particularly like in property, it's like you can build up, people can take that like fast speed accumulation strategy and then go through a period of like not doing anything, not having good habits.
Getting fat.
Maybe in the back of their mind thinking like, okay, no, I just need to like build up some more cash savings and this kind of thing, and then I'll like buy a bunch of properties again. But there's no guarantee that in that, you know, when you get to that 2 year or however long it takes mark, that you're going to be able to do that strategy again. Like so many things can change outside of your control as well. Yeah,
exactly. And the similarities between this wealth journey and that we're talking about and the health journey are you know, profound, right? So if you look at anyone who is in really good shape and has probably been in really good shape for a long period of time, and then maybe they're in their, you know, maybe in their late 50s, they're still in really good shape. What you'll probably find is they've developed consistent, regular habits and the right cadence. So those habits might be that they that they watch what they eat or whatever, but they also probably have a consistent workout routine. They do 3 times or 5 times a week or whatever the cadence may be. Maybe they cycle 3 times a week or whatever, right? But it's that consistency that is the key to them getting and maintaining the results that they've got. Now, so I think there is a time and place for going fast, and sometimes it is completely viable and relevant and the right thing to do. So, for example, if you've got a life-changing event which is coming up and you can see that on the horizon, you may very well go, well, I can see that things are going to change for me in 6 months or 12 months' time. So what I want to do is I want to absolutely capitalize on my current position as much as I can, because I know that when I pass that threshold, things are going to be different. And we've had plenty of clients like that where, for example, they go, look, in 12 months' time, we're going to change careers and industries, and our income's going to radically change. And so we won't have borrowing capacity. So we need to go as fast as we can. So there's situations like that where there can be a reason to go faster. Okay. However, but if we go back to the guy that I was talking to, you know, who's in his mid to late 50s and was wanting to sort of, you could almost like, oh my God, should we just quickly go and do them all? I mean, what I said to him was like, well, what if we bought 3 properties in the next 12 months? And then if we bought 3 properties in the next 12 months, and then if we bought 3 properties in the next 12 months, you would have 9 properties in 3 years. I said, do you think that sounds fast enough? Like, how many people do you know have bought 9 properties in 3 years? And he said, well, no one, right? So very quickly, if you develop the right cadence, you can actually get better consistency. And what's going to happen as well is that you will have a more enjoyable journey, but also you will have a better cash efficiency in your journey as well, in many ways. Because what let's just say you build a cadence. Let's say your cadence is to buy 1 property every 3 months, right? So you may buy 1 property, and then if you've got surplus cash left over 3 months later, or, you know, could be 3 months after the first property goes unconditional or whatever the case may be, buy another property, and then do another property another 3 months after that. What's going to happen is you're going to be consistently in tune and in touch with your portfolio, which is a really interesting thing. And so you're going to have your finger on the pulse of like what's happening and what's changing, and you're going to be building habits around how to develop that cadence. And I think that over like a short to medium term time horizon, people who can develop the right cadence rather than just this idea of like quick, let's rush. I think they're the ones that are actually going to end up in a better financial health over time, because, as I say, you're going to be consistently reviewing your portfolio, and having regular check-in points. So I think there's some really good tips that we could probably share on how to develop that kind of consistency as well. But what do you think about this, like this kind of speed versus consistency angle? What's your opinion?
Yeah, I think the analogy I was thinking of was like with the speed thing. It's like if you're running a race, and, you know, the home stretch is the last 100 meters, right? If it's a 100-meter race, you're going to want to run as fast as you can, because you've got 100 meters, and you know what the end point is, whatever that is, your change in circumstances. So you're going to want to go as fast as you can in that amount of time. But if it's a 5-kilometer race, you don't need to go that fast and that hard the whole time.
It's way more important that you get the right cadence and that you go consistent, right?
Yeah, it's about stamina at that point. And then maybe when you get towards the last 100 meters, you might actually be at the front of the pack because you've actually managed your resources so that you can either push really hard in the home straight if you need to or if you want to, or you can just like wander your way through the finish line and be stoked. Yeah, but I was thinking, like, I know we've got some points that are going to be a bit more, like, specific about, like, how do we know mechanically, like, what do we need in place before we can...
Totally, because I think that's really important to setting your cadence.
Yeah, but I just wanted to touch on, like, it seems like a lot of it is also about, like, emotional fortitude. And this is one of your kind of, like, favorite things to throw around is, like, people that come on board, particularly with us, that want to buy, 2 or 3 properties at one time, which sounds exciting and it's totally possible for us to do. But a lot of our assessment is about, like, is that individual actually emotionally prepared? A, with what's going on in their current life, but B, also, like, do they have the maturity and the readiness to handle the resilience, to handle that amount of activity at one point in time. So, like, working with us, like, we do so much of the work for you and so much of the communication and stuff on your behalf, but there is still work that goes into it on your behalf. There's still stress. Like, you're still buying a property that requires you to interact with your mortgage broker and requires all of this other stuff, paperwork. Like, there's all of this stuff that happens, and delays come up all the time. Dates change. Like, fires catch on. Like, things pop up all the time. Not literal fires. Hopefully not.
We haven't had any properties on fire yet.
No, thank God. So. But things pop up all the time, and so you do need that resiliency. You need to. It's a contingency that you kind of need to expect in the process. Even when things are, like, the smoothest, something is going to pop up that's going to cause you stress that you didn't anticipate. So if you layer, like, 5 of those purchases on top of each other, for most people that's just too much. Yeah,
most people don't have the time, right? Because it's the classic, like, time, money. Like, you either have the money and not time, or you have the time and not the money, right? So if you're sitting around doing nothing and you've got nothing to fill your days, sure, absolutely, maybe that's no problem. But probably most likely scenario is you're also probably not going to be buying into houses because you might not have serviceability and stuff. So it's really about understanding that balance too. Yeah.
Whereas, like, I'm thinking through, like, quite a few of our clients who did sign up were like, look, I'm ready. I'm at this point now where I want to buy, 3 in the next 6 months. Can we try and look at them all right now? But we said, you know what, just let's go through one first. Once it settles, then we'll start to do the second one. And so through the first journey, like, they hadn't bought properties before. So there was a bit of confusion, a bit of education on our part, them getting up to speed with the whole process and the communication that's required with other people and all the finance work and stuff. But then as they're now coming through the second process, they're way more confident. The workload is still the same, but they're like, no, I've got this. Like, I know I need to have this prepared. I need to have these funds here. Like, and then you can imagine, like, you build up to the third one, the fourth one, like, consistency on that cadence. It builds that natural self-esteem and confidence in what you're doing.
Totally.
So it's on top of the result that you'll get. Like, it's I know what I'm doing.
There's another part in there too, which is really, really important to understand. So, like, let's just say you have the purchasing power to go and buy $2 million worth of property, right? And if you want to approach it with a shotgun blast and go, right, I want to go buy 4 $500,000 properties, bam, let's go. Like, that's totally cool. Absolutely. Not a problem. Can be done. No dramas. But here's the reality of the situation, right? If you aim to buy a $500,000 property, you may end up spending $450, $475, $420, $480. It could be any, like, the statistical likelihood of it being $500,000 exactly is extremely low, let alone that happening 4 times collectively. And so what can end up happening is, let's just say you ended up buying 4 properties at around about $475,000, then that's $25,000 less each that you end up spending. And so you can end up with $100,000 of purchasing power left on the table, which you then might not actually be able to distribute across the properties. But if you were to, say, buy one property, get it to unconditional, because then okay, it's unconditional. We're now about to move into the settlement phase. So right, that property is actually $472,650. So now how do we need to think about adjusting our available capital and borrowing capacity for the subsequent purchases? And so you can actually rapidly end up maximising your distribution of capital, and that's what I was talking about, a more efficient distribution of capital, because you'll know where you stand rather than accidentally being left with some funds left over, which is not bad, hey, to have some money left over. But if the goal is to try and have it invested and working for you, you don't want lazy money sitting around. And so giving you that space, I mean, the difference that it might only be like two months apart. If you're doing it at unconditional, you might start the process. It might take 2 months to find and negotiate the property, etc., and get it unconditional. And then as soon as it's unconditional, you can start again. And then that process might take 60 days. And in the meantime, you've got 30 days of settlement on the first one. And so halfway through looking for the second one, you're already settling on the first one. And so you can layer them up really, really quickly. But again, it's about understanding how to split those apart and why.
100%. And it's like, I always think about it like you need to, every day is the new day one. Like you need to buy something, and then once you've like gone unconditional, so we say unconditional because that's the point generally where you know how much cash is going to have need to go into that deal. So you might have thought you needed 100 grand, but actually you needed 110. So then you've got this 10,000. But you know, once you know that amount, you reset and you're like, okay, now I've got this asset that's in my portfolio. Now is the new day one. What do I need to do to get to my goals still, now that today is the new day one? And then with every purchase, you reset and go, okay, now this is my situation. What do I need to change? Yeah.
So there's a few things that we want to get through, right? So I want to start trying to move through them because I think they're all really relevant to this, because one of the questions, well, like let's say you go, okay, great, cool. So I'm going to set like a cadence to my portfolio. What should that cadence be? Like what should that pace be? And this kind of goes back to actually one of our clients I was talking to who is in his early 30s, and he was sort of saying like, is one a year sort of the right cadence, and maybe I've got money just sitting around doing nothing, and like how do you know? Like how do you know when to go again, right? And I think it comes down to a few things, because there's an argument that you could say, well, you should go as fast as you can, and as soon as you've got capital, go again. But what does that really mean, right? Does that mean, let's say you buy a $300,000 property, and let's say it goes up by $20,000. Does that mean that you should scrape out whatever $15,000 of equity and put that into cash, and then go buy some cheap property just because you can? And no, like that shouldn't necessarily be the goal, right? So you kind of need to set some investing rules, but you should also be thinking about your capital position, like how much would be required to be able to buy the next property. What's the strategy and everything like that. And I think where a lot of investors can go wrong is they can start going into what we call a doom loop. And a doom loop is when you have a consistently diminishing return on your efforts. So for example, let's say you buy a $300,000 property, it goes up by 10%, you got $30,000. For simplicity's sake, we'll say you can take out the entire 10%, even though, of course, loan to value ratio wouldn't allow that. But for the purposes of the mental model, $300,000 property now, and then it goes up by 10%. You go, great. Oh, all I need is 10% for a deposit. So you take out the 30 grand. The thing is, of course, you've got purchasing costs on top of that, somewhere between 5 and 8%. So simplicity, we'll call it another 10%. So we'll say 20%. So in actuality, you're going to be able to buy a cheaper property, not another $300,000 property. And then when that property goes up by 10%, and now over time, what's going to happen, of course, is you'll end up with 3 or 4 or 5 properties. One will be 300, one will be, 250, and one will be 200, and one will be 150. And, I'm obviously exaggerating those steps a little bit, but yes, all of those properties will go up and theoretically and, produce income and do all of that kind of stuff. But the problem is it's not necessarily going to be the optimal distribution of your capital. And so that can end up creating a diminishing cycle or a doom loop rather than, an exponential growth curve, which is a very different way of thinking about it. So understanding when and how to go again is really important. You're going to be looking at like how much cash have you saved? Have you got additional money to contribute to your portfolio or not? Are you still in stable employment? Is anything going to change? What's happening in life? You're about to have a baby. You're getting married. What's going on there? There's all these kind of things. But realistically as well, it's about understanding at what point, at what benchmark are you satisfied to go again, right? So you might say, okay, well, I bought the first property for $300,000 and my investment rules, because every major investment organization, every investment bank, every portfolio manager, Ray Dalio, the whole shooting match, they all have rules. They all have rules.
Yep.
And as an investor, you should have rules too. Like, you should have rules. Okay, my LVR, the LVR range in my portfolio must not go above or below X. I won't buy properties less than X or more than X. I want my portfolio yield to be X, or an individual property yields to be X, right? So you can create all these kind of rules, and they're going to give you the guiding light as to when you should potentially go again. So if you want to avoid going into a doom loop, right, and let's assume that you're not contributing any additional capital to your portfolio, which, again, if you want a healthier portfolio, you should probably be considering saving and putting money into your portfolio, as well as, leveraging the growth and doing all of that kind of stuff. But you want to be looking to make sure that you are getting enough capital out of your properties to cover the deposit plus the purchasing costs, etc., and to make sure that you're going up and not down. So you might, even if you only bought $300,000 properties but never went 300, then 280, then 270, then 250, and then 220, then that would probably still be better. And that's going to dictate your cadence, right? Mm-hmm. So you, on the one hand, you want to go as fast as possible within the constraints of your portfolio rules, right? And that is the dictation.
Yeah, I love this concept because it's so tailorable, and it needs to be tailorable to everyone's personal situation. It's like identifying with yourself, like, what am I actually comfortable spending? What am I happy to be able to save? Like, if I set a rule for myself, like, I have to have at least 50 grand of savings before I look at buying my next property. And you just have that as a rule for yourself, because otherwise, if it's, lower than that, then you end up relying just on equity redraws rather than, like, as you said, trying to set this up to be a positive kind of flywheel momentum rather than a doom loop of.
Yeah, just to be clear, you can, if you want, just use equity, right? You don't have to. If you're a situation, if you've got a family and you just can't save or whatever, you can just use equity, but the point still remains the same. That you want to be making sure that you're only taking equity out of the property when you've had enough of a gain that you're going to be able to stay at the same value price property or up. So that will potentially slow down your journey. That's the action.
Yeah, for sure. And I think it's about, like always, it's knowing where you want to go.
Yeah.
And understanding yourself and the realities of your life and setting boundaries for yourself for what you want to, what you need to achieve to help you consistently move towards what you want to achieve in the long term.
Yep.
And so I think that's like for us, like one of our hard rules is like positive cash flow. Like, unless it is net positive cash flow, we don't even look at it. That said, we have some clients that aren't as hard a rule on that because that's their decision, and we have this conversation with them, explaining the pros and cons, and they're like, no, I would prefer, like, positive cash flow is not a necessity because they're super stable in their job and all this kind of stuff.
Yeah.
And they
1% of properties that we've bought, we did an analysis on it the other day. 1% of the properties that we bought haven't been net positive cash flow from day one, but that's been, as you said, at the within the investment rules of that client's portfolio, and understanding where that fits in with their portfolio, and typically it's because they've been development opportunities or something like that.
Yeah, and so I think, like, zooming out as well, like the Holy Trinity is exactly our investment rules, our philosophy 100%. as an organization. It's like we have these 3 rules that we follow, and that's how we consistently get the results and achieve the results we want. So I think it's really important for you to just take some time and think about, like, what am I actually comfortable, and, like, stretching it a little bit so that you know that you can push it and it will move you forward, but having those boundaries for yourself will really help with this.
Yeah, totally. And it's another really interesting way to think about, and we could go into portfolio mix. That's probably a whole nother podcast, really interesting one, is to think about what is the distribution of your assets by type. And so if you look at, like, a superannuation fund or whatever, or any major fund, what they'll have is they'll have different distributions on asset types. So they might have, 30% in commodities, 15% in cash, 5% in speculative, 20% in real infrastructure assets or whatever, right? So they'll have different weightings. And again, this comes down to understanding your portfolio rules. They'll establish those rules before they launch the fund. They'll say, the way a fund works really simply is that there'll be a hypothesis and a track record of people who can do stuff. And they'll say, hey, great, we want to raise whatever, $100 million. These are going to be our investing rules. And we believe if we follow these investing rules, that we're going to achieve these returns. Would you like to contribute capital to the fund? And that's how you're going to make money, right?
Mm-hmm.
And that's all it is. That's literally all it is. And your portfolio shouldn't be any different. It's just that you're the key investor in your fund, right? Your personal wealth fund. And so you've got to say, okay, what are my investment rules? What's my distribution going to be? Am I going to have, only buy foundation level properties, or am I going to be satisfied with 3 foundation properties, but then what I want to do, or 3 properties between 300,000 and 400,000, but then what I want to do is I really want to start diversifying by price point or yield point or asset type. Maybe I want to get one development in there, or one developable property, just to be clear, one developable property in there, but then I also want at least one triplex. You can really start to think about what that portfolio mix looks like. And I think that's where setting your investment rules is really good, because otherwise you sort of don't really know. You're like, all right, do I just keep buying houses? Like what houses, why and when, and like all of that kind of stuff. So I think if you can break that down and go, okay, well, here are the parameters with which I'm going to operate my portfolio, it allows you a greater level of clarity. And then again, going back to at the very start, if you have those rules, then you should go as fast as you can. Okay? Mm-hmm. Because the compound effect over time is that the sooner you can accumulate the assets, the more return you're going to get over a shorter period of time. Again, the caveat being that it's got to fit with your investing rules in the right cadence. Okay? So that kind of goes on to probably the next point is like, how do you, like, what systems and tools can you put in place to manage your portfolio a little bit better and to develop that?
Yeah, I just wanted to just finish on that. What I'm thinking of is like your portfolio rules are like the bumper rails on a bowling alley. Yeah. Like you put up these rails so that you have your principles and your guidelines of like, okay, this is where I don't want to go past. I don't want to fall into the gutter. So I put these up, but then in terms of bowling, like you go as fast as you can down that, and you know that they're going to keep you aligned with where you want to go. The risk I see here though is people setting rules that are unreasonable because they just kind of like feel like that's what they want to do. So like people might go like, I only buy subdividable property. Yeah. But then their goal might be not related to subdivisions. So it's about,
Yeah, that's understanding strategic alignment, right? Yeah. That's like, if you wanted to achieve $100,000 cash flow in 5 years, what is the best configuration of assets to achieve that? Yep. And buying only developable sites may or may not actually be the right pathway to get you there for sure, 100%. And just to your point as well, and I know you want to finish on that, but it's a really interesting thing you touched on is that sometimes people can have investing rules where in fact they're just investing like optimal scenarios. Like they might say, well, my portfolio investment rules are that I only buy 8% yielding properties within 10 kilometers of a capital city CBD. They're my rules, and so I'm going to stick to them. And it's like, well, realistically, like, is that practical, probable? Is that going to get you the best results? Are you setting yourself up for failure? So it's a whole nother, how to set those rules is probably a whole nother.
Yeah, it's striking a balance between what is going to motivate you and keep you moving forward, but what is actually realistic to help you to achieve your goals. Like even location might be one of them, because a lot of people still I live in Melbourne, I want to buy at least in Victoria so I can drive there, that kind of thing. Yeah. So it's a good, a place to start, but if it's going to hinder you from actually accessing the opportunities that will actually move you forward, then it's something to reconsider.
100%.
I just want to quickly get on like cash saved. So obviously it depends on your rules, as we talked about, determining your own, like if you don't want to only use equity to refinance and go again, is there an indication of like how much cash people should maybe at least minimum start with? So
if you don't use equity, or?
Yes.
So if you're not going to take any equity out of the properties?
Yep.
Again, it depends on your portfolio rules, but I would say 50 grand.
50 grand. Cool. Yeah.
I'd say 50 grand is like a baseline
Yep.
That would be a low baseline. Like if you're engaging professionals like us, then there's going to be, some additional costs and stuff in there. And I just think, realistically, if you're less than 50 grand, probably keep saving. Unless, here's the caveat to that, unless your savings rate is slower than the potential growth rate you could get for the property, right? So let's say you had 30 grand, but it was going to take you 5 years to save up the other 20. Well, then maybe you're better off getting into a property that's going to help accelerate savings. But as a general rule of thumb, I'd say 50 grand as a minimum. Yep. If you are only using cash.
Yep. Perfect.
Great.
Okay,
awesome. So what I think is good to talk about now, because it's like people are like, okay, cool, got it, great. I need to set some rules and I need to set the right cadence. But what is the right cadence, and how should I think about doing that? And more specifically, how can I get more organized? Now, this comes down to basically treating your portfolio like a business, right? Now, in any business, actually, it's probably a long bow to draw. I would say most intelligent businesses would do a quarterly planning session. They would do a quarterly review. How did we perform over the last quarter? And then a quarterly forward planning. What are our goals, KPIs, and objectives for the next quarter, right?
Mm-hmm. That can be called a review preview.
Yeah, a review preview, right? Yep. And I believe that all property investors should do a quarterly review preview of their portfolio. Now, the reason for that is it's going to give you a regular check-in point to assess where you're currently at. Now, within the context of saying, well, you should go as fast as you can within the investment rules of your portfolio, and of course within the financial, considerations of your family and life and all of that kind of stuff, then some of the ways you can do that, because a lot of people are like, well, is one a year the right cadence? Should it be one every month? Should it be one every 6 months or whatever? The point is that you should consistently review the health of your portfolio, because you might say, oh, well, I don't know, maybe it's like once every year, whereas in actuality, maybe your properties are growing and performing really well, and maybe you could go every 3 months, for example. So I tend to think that quarterly is a really good check-in point. And so what you can do every quarter is you can speak to your broker and just ask, hey, can you order some valuations for the properties that I've got? I want to see if I've got any equity and if I can go again. Now, that's a good step. And the way to build consistency with that is to set a reminder in your calendar, for example, every 3 months, contact the broker, right? Mm-hmm. And so you'll then have an alert. So you don't even need to think about it. It could be on the 1st of July, 1st of September, or whatever, to go, hey, cool, it's time to reach out to the broker. Hey, broker, it's me again. Just want to check in. Have I got any equity in these properties? Want to know if I can go again, mm-hmm. right? Now, if you do that, maybe you don't at that point, but maybe you're really close and you might say, okay, cool, I'll check in again in a month, right? Or 2 months. Otherwise, it might just be like, okay, great, back to you again next quarter, move on. Mm-hmm. Now, there's a few tactical things that I want to throw in here as well to help manage this a little bit better, because some people also don't really understand, like I think my properties are positive cash flow. It seems like there's money in the bank. Gets a little bit confusing and a little bit messy. Mm-hmm. So there are simple ways that you can help to manage this a little better. Like, so for example, you can get accounting and cash flow management systems like Xero, and there are a whole bunch of other ones probably simpler than Xero. Xero is an accounting platform that you can get, and you can put your properties into Xero like business units basically. Mm-hmm. And then you can set up things like receipt bank, and then you can spend, say, 1 hour a week or 2 hours a month or whatever needs to be done for your portfolio to go, okay, what are my cash inflows and what are my cash outflows? And that way you're going to be able to catch things in your portfolio like, oh, wait, hang on a second. I thought insurance was going to cost X, but it's actually costing X, or I had allowed this much for maintenance, but in actuality it's costing me more or less. And you'll be able to catch all that stuff early, so you have a better head check on what's going on with your portfolio. Now, the reason that you want to do all of this is so that you're consistently in tune with the health of your portfolio, and then you're creating the right structure and system. So you might have, you could set up, the financial tracking systems using something like Receipt Bank or something like Xero. And again, there are plenty of other, tools out there that you could use to achieve a similar effect. And then you could just say, well, once a month, I'm going to review my cash inflows and my cash outflows, and I'm going to check in with my property manager or property managers once a month. Just, you can dedicate 4 hours, one afternoon on a Friday, last Friday of every month could be, for example, Well, you ring around, you go, hey guys, just want to check in. How's everything going? How's everything with the tenants? Is there anything I need to know? Is there any outstanding items that you haven't sent through? What's the rental market looking like? When do you think we could put the rent up, etc. Right?
Mm-hmm.
All of that kind of stuff. And then check your cash inflows and cash outflows to know, okay, is this profitable or not? Am I producing more money than I'm using? If you do that, as well as having a consistent, regular timing of like, okay, every 3 months I check in with the broker and go, hey, can I borrow again? What's going on? Like, can you do an assessment on my borrowing capacity? Has it gone up or gone down? Can I refinance any of the properties? Is there a better loan product for me? Is there some way that I can optimize my portfolio? Just doing that is going to give you a much better process-driven approach to your portfolio, which will likely end up with you buying, 2, 3, 4 properties every year for a long period of time, because you'll be approaching it with a different mindset and a different level of professionality.
Yeah, for sure. And I think the funny thing with this is that it's nowhere near as sexy as the time when you're going to buy a new property. This is the maintenance work. Like, this is the habits that actually help people to succeed in whatever they want to do. Like, it's the maintenance, the daily, weekly, monthly, quarterly habits that people take and stick to that actually help them to succeed in whatever they're trying to do. So it's not necessarily all the excitement those few months when you're buying a property that is moving you forward. Obviously, you're doing the action that will move you forward, but it's all the supporting activities that you do and stick to that will make sure that you are taking this seriously and taking it professionally. And so from on the quarterly review as well, you can, if you have a good property manager, getting a quarterly, as you said, you can reach out to your broker to get an update on your borrowing capacity and a valuation on your property, is to see like on the asset and income side of things, like where are you sitting there. But on the expenses side of things, you can work with your property manager as well to see if on a quarterly basis they can send you an export of all of the expenses that have come through that property as well. And so if you're using an accounting software like Xero or something, you can then match them and reconcile them and make sure that you know where all the money has gone. And from like a daily, just general hygiene, like businesses have separate bank accounts for the business, separate from the directors of the business. So the company itself owns a bank account or several where the money comes in and goes out, so that every transaction that's in that bank account is related to that business and not related to the directors. And so this is a really critical thing that I always advise people, is set up at least one separate bank account for your property investment.
Preferably one bank account per property.
Yeah, preferably one bank account per property. So it just needs to be like an everyday transaction account where all of your cash, like all of your rental income goes into that account, and then all of your repayments and any of your invoices that come in that you need to pay go out of that account. So you can really clearly see, is your cash balance going up or down? And if you're positive cash flow, it should consistently be going up. And you're always going to consistently have a real delineation between your accounts of what is actually related to each property, so that if you're doing it, because even if you do it on a quarterly basis, if you've got all of your transactions just going through your normal life account, you're going to have to go through every single transaction that you've ever made using your personal card in that 3 months. And that can be quite a few, when maybe they're not really relevant to your portfolio. Whereas if you split it out into different bank accounts, you might have 10 transactions for the quarter, and you can easily get through that and have conversations with people about it. So that's just on a really general hygiene, like have separate bank accounts if you can. And they're really easy to set up. You just contact your bank. You can do most of them online now. You just request open a new account. So it's definitely worth it.
Yeah. And there are lots of tools that you can connect with your bank. You don't have to use Xero, but there are lots of other tools you can connect with your bank accounts.
Yep. One that we've tried recently is called PocketSmith.
Yeah, PocketSmith is pretty cool.
PocketSmith is really good because you can actually put in your your asset value into it. Probably, I haven't fully worked out like how accurate it is in terms of like measuring the uplift in like a growth in a property, but you can put in all of your assets and your liabilities.
Can you update the asset values, Gabby?
Yeah, you can.
Oh, okay. Yeah. So that was one of the things I liked about Xero, is because if you go and update the equity in your balance sheet of your account, it's going to, like, you would be able to change you'll show it on the balance sheet. I didn't realize you could do that.
Yeah, I think you can in Pocketsmith. Yeah, which is awesome. And so the way that it works as well, so it does that whole balance sheet side of things for your personal finances. So again, it's like Xero is one for like a business, but then Pocketsmith we found is really good for like personal
finance. Yeah.
And so it also connects with your bank accounts where you can reconcile all of the transactions that come through based on the exact like actual transactions in your account. And so you can actually track like, okay, I expected this quarter I would spend $1,000 on lawn mowing and I spent $1,200. Okay, that's a bit higher than I anticipated. And then you can have a conversation about it with your property manager. But yeah, Pocketsmith. Haven't fully like pulled it apart, but I know it's got really good functionality if you've got the time to.
These are just ideas as well, by the way. If anyone out there has some other good solutions, send them through so we can share them with other listeners as well.
100%.
Because that would be really cool. Like our goal really is like, how do we help people to, you know, do more, better, faster, and have a better life? So if there's a better way of doing it, that would be awesome to know as well.
Yep. One final habit, actually, when you are looking to buy a new investment, right? You know you've got your boundaries. Sorry?
Talk to us. That's the habit, right?
That's a really good habit. Guys, reach out. I was going to say use an Apex report. So if you guys haven't downloaded one already, it is a spreadsheet tool that we created ourselves that we use countless times a day between the team, assessing every single property that we do DD on to determine, is this property going to perform? Is it going to fit the mold that we need this next purchase to fit? So you set these rules that you have for yourself or your next purchase, so like minimum yields, max purchase price, that kind of thing, and you plug in the details of the property and it will actually show you like, is this the right fit for what you need for this next purchase? So if you don't have that already, you should download it. I'll put it in the show notes so you can download it.
I think it's been downloaded like 15 or 20,000 times now.
Yeah, it's pretty cool.
Hectic.
It's pretty good.
Yeah.
Sweet.
Awesome. Okay, guys. Well, I hope this has been valuable. Now, Gabby, I don't know whether we should be calling this episode "How to Know When to Buy Your Next Investment Property" or "Property Portfolio Housekeeping and Hacks for Sustainable Scalability." But I guess,
mystery.
I guess you guys, the listener, are going to know by the time you click on this show. So, all right, guys, if this has been useful to you, it's probably been useful to somebody else. And what would really mean the world to us is if you could help us help more people by sharing this with somebody else too. Really, it's really important to us. We like to, we're driven, as you know, to listen to the show, driven by impact. And if you can help us to live out our vision, we would be happy to help you live out yours. And it all starts with giving. And what we're trying to do right now is give to you. And if you could give this to somebody else, that would be phenomenal. So without any further ado, make sure you like, rate, review, share, subscribe, do all the good stuff. But give this to somebody else. Help us to share this around and help us to help other people just like you. And if you need anything, then don't hesitate to reach out. Thanks.
Thanks.
See ya.